Yo, how's it going, guys? Welcome back to another video. Today, we're going to be discussing how to find direction in the markets, and we're going to be simplifying it through three easy concepts. Now, before we actually dive into this, I did want to go ahead and mention that we have an absolutely free Discord with a free course that we made in-house that dives into all the core concepts that we actually use on a daily basis to execute. And more importantly, we actually have a 7-day free trial that gives you guys access to all of the live streams that we do Monday through Friday, both in the morning, so you can see how we execute and our thought process, and then at night, so you can see exactly how we get ready for the session the night before. With that being said, if that's something that intrigues you guys, make sure to go ahead and check out the link in the description below. And without further ado, let's dive into the core topic of today's video. So, like I mentioned, three simple concepts that we're going to be using to ultimately optimize the way that we find direction within the markets. And these concepts are going to be market structure to gauge overall trend within the market, liquidity to be able to take note of significant swing highs and swing lows where the market can actually draw towards, and then lastly, understanding fair value gaps. And the reason for this being is because the market will generally do one of two things. It will either seek out areas of liquidity or it will seek out fair value gaps to rebalance these imbalances. Imbalances and fair value gaps are interchangeable terms, and the market will seek out to rebalance these fair value gaps before continuing in the underlying direction. So when we actually put all of this together, we are going to be able to more effectively find direction within the markets. Now let's actually break down these individual concepts with greater detail. All right, so first and foremost, market structure is extremely simple. Actually, all of these concepts, when we were going to break them down, is you guys are going to be able to see they're extremely simple. Market structure is a fundamental concept to be able to understand trend in the market. Now, what we know about trends in the market, there are two main types of trends, right? We have an uptrend, which will look something like this, which is composed of an initial high, an initial low, and then subsequent higher highs and higher lows. As we can see, this high is higher than the the previous high, and this low is higher than the previous higher low, hence indicating that we have an uptrend, right? Price is developing with momentum to the upside. Now, the complete opposite of that is going to be a downtrend, right? We're going to have price action developing with an initial low, an initial low, an initial high, and then a lower low, lower high, and so on and so forth. And this showcases downward momentum and price action developing to the downside with bearish market structure. Okay. Now, there's a huge misconception that markets just have to move with direction, right? We ultimately trend to the upside and then we trend to the downside, and that is it. Markets are just infinitely moving with direction and trend. That is not right whatsoever, guys. Markets actually tend to consolidate, right? Which is what we actually use to identify and recognize a market that has no trend. And what that will generally look like is something like this, where the market is just trading in between a respective top and a respective bottom with no breakouts to the upside or to the downside, hence no trend. And it is trading sideways. And we call that consolidation. All right. These are the basics of being able to understand trend and market structure. Now, once you guys can actually identify market structure and trends at its most basic level, we need to also be able to identify how these trends can shift and how we go about actually recognizing potential reversals within these trends. And the way that we're going to do that is through a break of structure. And this is another extremely simple concept that I'm going to showcase now. If we see a market developing with clear downward direction, right, we have subsequent lower highs and lower lows. A break of structure in this trend will ultimately occur when price action is able to break past the previous lower high and close above it, just like we see right here. This move is able to take out and close above this previous lower high, hence indicating a break of structure to the upside because now the market is shifting in potential trend, which is how we actually go about identifying a break of structure and a potential reversal. Just because we had a break of structure does not necessarily mean that we will see a full follow through in the direction that we had that break of structure. Hence why we use all these other concepts, right? Pairing them together to find direction more effectively. But it is the first part that we can actually use. And in this case, right, identify a reversal or when a reversal is potentially occurring via a break of structure. This is a break of structure to the upside. Now, a break of structure to the downside would simply be, let's go over here, in price action is developing with bullish structure, right? Higher highs and higher lows. And then we have price action ultimately take out and close below the previous significant higher low that we see right here. That right there is going to indicate the break of structure to the downside, and we may now see a full fall through to the downside. This is essentially how we go about recognizing potential reversals in the market using market structure. That is the first concept down. Now let's move on to liquidity. All right, now that we've covered market structure, let's actually dive into liquidity. This is a concept that once again gets overcomplicated in the social trading media space. And for the purposes of simply finding direction, which is what we're actually going to focus on today, this is all you guys really need to understand about liquidity. The way you guys visualize liquidity is simply as significant swing highs and swing lows. These should be highs and lows that stick out like a sore thumb on the chart. Significant swing highs and swing lows. And these are going to be magnets. I want you guys to view these as pools of money because there's a high likelihood of market participation at these areas, which is a fancy way of simply saying that these are areas where people are getting in and out of the market. Hence, there's a pool of money generally at these areas. Okay. So the market, right, like we mentioned earlier, will generally do one of two things. The first one that it will do is target these areas of liquidity. It will gravitate towards these areas of liquidity, which will ultimately help you gauge overall direction, since based on market structure and how price is developing, you can then gauge what area of liquidity it could potentially move towards, right? In this case, what do we see? We see price action had come down and taken out this first pool of liquidity, the sell side. And sell side, all it really means is essentially sell side liquidity, which is the liquidity sitting below significant lows. Okay. And then what we see is following that, we see a shift in market, an overall market trend. We take out this previous lower high, we start putting in higher highs and higher lows, and then price action starts moving and is likely going to gravitate towards the next pool of liquidity, which is this significant swing high, and the liquidity sitting above swing highs is going to be buy side liquidity. Okay, so sell side liquidity is liquidity sitting below significant lows. Buy side liquidity is liquidity sitting above significant highs. That is all that you're really doing. You're pointing out the significant swing highs and swing lows, seeing how market structure is developing in the context of these highs and lows that you are essentially drawing out, and seeing based on that market structure what high or low could be potentially then draw towards next. That is all that you are doing here. And I will actually showcase some examples of this on the charts now. All right, now that we're on the charts, like I mentioned earlier, these should be swing highs and swing lows that stick out like a sore thumb. So I'm just going to move from left to right. Here we had a significant swing low that, as we could see, once price ends up actually shifting structure to the downside, we end up targeting, taking it out right there. Beautiful. We had another significant swing low right here, sticks out like a sore thumb. And as we could see within that same candle, we took it out, right? As we continue, we had this low right here once again, and we saw that get taken out. More importantly, also in uptrends, right? We see that these significant swing highs that get made in an uptrend are obviously going to get targeted, um, and they're going to be taken out. Why? Because in an uptrend, after you retrace, you essentially pull back. If we're going to continue that uptrend, you have to push past and close above that previous higher high and put in a new higher high like we did right here. So previous higher highs, right, during an uptrend are going to be easy draws, which is why we relate it back to market structure and why we start with that concept first and foremost. And as we see, there's some more examples actually back here. Even when we start trending to the upside, what we see is we have this significant high that ends up getting taken out right there, and this significant high from the left that you can see getting taken out right there. So for an easy draw, you can always essentially look left and see what significant highs and lows were made previously under the context of where price action is developing right now. And right here, we can see perfect examples of these previous highs that ended up getting taken out beautifully. Even this low, right, gets taken out right there. We can continue. We have, for example, a high right here. It has not gotten taken out. This is actually going to serve as a perfect segue when we finish this off into the example where we put it all together. But right here, for example, we had another significant high that ends up getting taken out and targeted right there. So this is essentially liquidity, guys. Under the context of finding direction, it is that simple. You're just pointing out your significant swing highs and swing lows, and you're seeing how price is actually moving and gravitating towards these areas. Once again, right here. Beautiful. This should be easy, and you guys should be able to do it for days, honestly. Right here, boom, significance from high. You can see it's targeted right there. These are areas that should stick out like a sore thumb. So definitely go through it. Go through this exercise where you're pointing these out, pointing and marking out these areas, and then just see how price is actually reacting and gravitating towards these areas. That is all liquidity is. Let's go ahead and wrap it up with the third and final concept. All right. So the third and final concept that we're going to be covering is going to be fair value gaps. And just to repeat it really quickly, the reason for this is the market likes to do one of two things. Generally, will do one of two things. It will seek out areas of liquidity, or it will seek out to rebalance inefficiencies or imbalances, which are all interchangeable terms for fair value gaps. Now, what are fair value gaps and how do we actually find them? The proper definition of what the fair value gap is essentially is a three candlestick pattern where you have a move in one direction where it essentially leaves a lack of orders in the opposing direction. Hence, price action will then come down to that area, fill that imbalance, and then continue. That is personally the way I view it is that is a fancy way of essentially just saying it's a retracement tool because that's all it really is. Price action will retrace to these areas before continuing in the underlying direction. So what we're going to focus on is how to actually find them and visualize them. So like I mentioned, they're a three candlestick pattern, and starting off with a bullish case, all you actually need to visualize them is the first candle's top wick does not meet with the third candle's bottom wick. And there's going to be a space in that range between them, creating that area of fair value, leaving that fair value gap. So you'd be looking for price action to return, fill that fair value gap, and then continue to the upside for the bullish case. Now, for the bearish case, it's going to be the same principles, just swap. The first candle's bottom wick is not going to meet with the third candle's top wick, and that range, that space in between them, is going to leave your area of fair value, that fair value gap where you're looking for price action to retrace back into it, tap it, fill it, and then continue to the downside. That is all a fair value gap is. So this essentially, it's an area of retracement that we're going to be using and looking for price action to pull back into before continuing in that underlying direction. Now we've gone over all of the three core concepts that we're going to be utilizing to find direction more effectively in the markets. Now I want to showcase some examples of putting all of this together so you guys can see how we actually go about doing so. All right, guys, now that we're on the charts, I actually want to showcase three different examples with putting all of these three concepts together so you can actually see how we can put them together to more effectively actually gauge and find overall direction. So we're going to go from the most current one and essentially moving ourselves back. So what we could see here, right, we're going to be focusing on this specific move. And what I'm actually going to be doing is replaying it piece by piece. So the first part, what we're going to be doing, market structure, right, like we talked about. What do we see currently with the trends that we have on the charts right now? Well, we saw we had a push to the upside, right? We then had a momentary break of structure where we then start to kind of consolidate. And now we have another continuation to the upside, not a continuation, excuse me, but rather a break of structure to the upside with some nice momentum, as we could see clearly right here, because we were able to take out all of these previous lower highs and stacked lower highs that we had right here with some nice momentum in essentially four candles. So we have significance and we have context right there in that move. And we can clearly tell now that we had that break of structure to the upside. So most likely the market is going to then now continue drawing towards the upside. Based on what we see right now, where do we think the market can likely draw to? Before I answer that, I'm going to point out A or B. These are our two nearest most significant pools of liquidity. A, right? If I'm looking at this, I'm thinking, well, A is probably the next area that we'll draw to because we are right there. I mean, price action would essentially have to take down and eat up this entire fade, this entire move, and ultimately potentially, break structure on the lower time frames to take out this sell side down here. So the more obvious draw is going to be this buy side right here. So we have liquidity right there done. But more importantly, we also saw that this move took out this previous pool of liquidity. So now we had market structure, which is bullish. We actually had a draw towards this previous buy side. And what we've covered is that the market generally likes to do one of two things. It's either seeking areas of liquidity or it's looking to fill imbalances. In this case, we already seeked out this area of liquidity, so we could potentially retrace to an imbalance. Do we see any imbalance that got created from this move that took out this high? Yes, we do. We see a bullish fair value gap that gets made right here. 4-hour bullish fair value gap, right? Top wick doesn't meet with the bottom wick of the third candle. And if we replace price action, we could see that price now retraced back into this 4-hour fair value gap. Okay. Market structure is bullish, our draw on liquidity is bullish, and we just respected a bullish fair value gap. We are most likely going to draw towards this high. And if we actually play price action out, I don't think we actually get it just yet. If we really zoom in, so this is the high, we have not met that draw just yet. We're essentially consolidating right below, but we have these like stacked highs that we're making relative equal highs right there. So this will be the more obvious draw if we continue holding overall bullish structure and respecting this previous fair value gap that we had already filled. This is a perfect example of actually being able to put everything together and seeing it. Now, let's go ahead and take this out and find another example of this, which we have right here. So let me go on the replay. Boom. Why is this move significant? Because this move broke structure to the upside. We got to break a structure to the upside, showing us that the market could be now trending and fully following through to the upside. This move also left us a bullish fair value gap, right? The top wick of the first candle does not meet with the bottom wick of the third candle. We see that right here. So we have market structures now could be potentially bullish with that break structure to the upside. We now have the third part, right? The fair value gap that we can potentially retrace to. And if we were to retrace to, where would we most likely draw to? Well, it would be the significant high that we would need to take out and draw towards to then continue to the upside, right? So we can go ahead. What do we see? We retraced back into that bullish fair value gap, filled it, and price should gravitate towards that next high, which as we could see almost, pretty much gets taken out, but barely. That's the high. It barely, yeah, it doesn't get taken out. I'm not gonna lie. Yeah, it doesn't get taken out. It almost gets taken out, but that is our obvious draw. But what we also see is that with that move, with this higher low that got created in the next leg, we have another bullish fair value gap that we can potentially draw into, which we do. And what would be the obvious draw? Well, these stacked highs, right? We have the high here and the high here that almost took out the initial high. We have stacked relative highs, and boom, we have that. So we had the overall bullish market structure after the higher low got printed. We had the obvious draw. We also had the fair value gap that we could retrace into. All three of the concepts we can clearly see showcased here, and we had that fall through to the upside. Now, one last scenario, an example that I want to showcase is this one right here. So let's go to right here. Why is this move significant? Well, this is a significant move because first we start off with market structure. We had a break of structure above these lower highs with this big candle that also took out these highs. So we had a significant move with momentum, establishing that direction to the upside. And we're actually seeing a follow through because we printed a higher low and we actually continued past the previous higher high, showing that continuation to the upside. Okay, so we have bullish market structure. We also have an obvious draw right here that we actually took out, and the next obvious draw will ultimately be this buy side right here. What did we cover in that first scenario that we saw? Well, once we actually took out buy side, we've already done one of the two things that the market likes to do. So do we have any imbalance or fair value gap that the market can retrace to? Indeed, we do. We have this 4-hour bullish fair value gap that got made during that continuation leg to the upside. So now let's see if the market will fill that fair value gap. It does right there. I was waiting for that candle to print. It does right there, as we can see. And then we actually have a continuation to the upside. And actually, before we ever retraced into that, we actually drew towards this high first and then retraced to that fair value gap and then ended up drawing towards the next high. Because if we're going to continue, we had to take out this previous higher high and then put in another higher high like we do right there. And that's it. That's literally how you guys can go about finding direction. Gauge market structure, gauge your relative draws on liquidity based on how market structure is developing and where price action is at right now, and then see what fair value gaps you can have that you see created, because based on whether or not price has already taken out a significant high or significant low, you could then retrace to that fair value gap before establishing direction to where it was trending previously. Okay, that is going to wrap up this video. It does not have to get more complicated than that, ladies and gents. With that being said, as always, stay safe, stay blessed, and I will catch you guys in the next video.